Welcome to another TCP walkthrough video. I'm Logan, and in today's video, we're going to be going over equity securities and corporate bonds. And we're going to be doing that the SuperfastCPA CPA way, which is diving straight into questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and check out our free 1-hour webinar training. We go over the key ingredients to passing the CPA exam, and again, it's only 1 hour, it's free, and it is something that will save you so much time struggling with your process. Make sure you go check it out. The link will be in the description. Also, just letting you know, we will only be going over 5 questions in this video, whereas Superfast CPA members will have access to the full video where we go over 10 questions, or in this case, 9 questions, just letting you know. So if you like this, you can get more of it by becoming a Superfast CPA member. With all that said, let's dive straight into the questions. Okay, here is question 1. Which of the following statements is true about equity securities? Okay, you might not know what equity securities are, or you might not know very much about them. So since this is the first question of the video, we're just going to dive straight into the answer to start learning what all this means. Okay, and the answer is C. Equity securities grant the holder ownership interest in a company, which may include voting rights and dividends. Okay, let's read about this. Equity securities, such as stocks, represent ownership in a company. Holders of equity securities may benefit from voting rights and dividends, which are portions of the company's profits distributed to shareholders. Unlike debt securities such as bonds, and it did mention some stuff that would be pertinent to bonds up here, which typically have fixed interest payments and a return of principal at maturity, equity securities offer returns that are dependent on the company's performance and are not guaranteed. Equity investments can vary in duration and are not limited to short-term holdings. So basically, equity securities are stocks and things like that, different from bonds, and it looks like in contrast to bonds, it actually gives you ownership in a company. So with just that first question, we learned a little bit about equity securities, so let's go to the next question to learn a little bit more. Okay, here is question 2. Which of the following is a primary risk associated with investing in equity securities? Okay, we learned a little bit about equity securities in the first question. It kind of talked about how there's not a guaranteed return, it's based on the company and things like that. So take a second, pause the video, think about the things we just learned in the first question, and see if you can think through what would be the big risk for equity securities, and come back when you're ready and we'll look at the answer together. Okay, looks like C, market risk, is the one that would be right. So due to fluctuating prices and the possibility of losing investment value, again, that's a risk for equity securities. So let's read through this. Market risk is a primary concern for investors in equity securities because the value of stocks can fluctuate widely based on overall market conditions, company performance, and economic factors. This volatility means that the investment's value can decrease, potentially resulting in losses. Unlike debt securities, equities do not have fixed payments and their returns are not guaranteed, making them susceptible to market fluctuations. This risk underscores the potential for both high returns and significant losses. So basically we learned right there that, again, it kind of mentioned this in the first question, but equity securities can be really volatile. They are super subject to how the market's doing, to other economic factors. A whole bunch of things can affect the stocks. So you can either make a ton of money or you can lose a lot of money. And we've all seen things from the stock market. Think of GameStop. Crazy things like that can happen to people's benefit, or crazy things like that can happen to people's big detriment. So that's something that you really need to be aware of when you think of equity securities, is that they are very susceptible to market risk, whereas they're not really very susceptible necessarily to interest rate risk, because that's more of a debt security or bond thing. And also stocks are pretty liquid. That's kind of the point of stocks. They can be traded pretty easily. So that's not a problem either. And again, reinvestment similarly isn't really a big risk for equity securities because they can be reinvested fairly easily. All right, let's go to the next question. Okay, here is question 3. How do the risks of investing in equity securities generally compare to the risks of investing in corporate bonds? Okay, we've already learned a lot about the risks of equity securities and a little bit about bonds. So go ahead, pause the video, kind of think through this and see if you can figure out what the correct answer is. And when you're ready, come back, we'll look at the answer together. Okay, here is the answer, B. They typically have higher market rate risk, and again, we kind of looked at that before, so let's read through this. Equity securities, or stocks, are known for their high market risk, as their prices can vary significantly due to company performance and market conditions. Again, we already looked at this. They can have a higher return, but they can also have a really big loss. On the other hand, corporate bonds carry credit risk, which is the risk of the issuer defaulting on payments, and interest rate risk, where the value of bonds can decrease if interest rates rise. Although corporate bonds can provide stable income through regular interest payments, they do not offer the growth potential typically associated with equities. So it's kind of either or. Corporate bonds are a little bit more steady, not as high returns, but a little bit more safe, whereas equity securities, such as stocks, can be really high return or really big loss. And if you'll notice, it does explain why the other ones are incorrect. So again, pause the video if you want and kind of read through those just to make sure you understand the other risks or things that might affect corporate bonds or equity securities. And when you're ready, let's go to the next question. All right, here is question 4. Which of the following describes a corporate bond? So we've talked a lot about equity securities and a little bit about corporate bonds up to this point, but now this question is specifically asking about corporate bonds. So if you want, go ahead, pause the video and kind of think through this based on the small things that we've learned about corporate bonds. But if not, let's go ahead and go straight into the answer to learn basically what a corporate bond is. Okay, and the answer is B. A corporate bond is a financial instrument issued by a corporation that represents a loan from the investor to the company, providing periodic interest payments and the return of principal at maturity. Okay, let's read this explanation. A corporate bond is essentially a debt security issued by a corporation to raise funds. Investors who purchase corporate bonds are lending money to the issuing company in exchange for periodic interest payments and the eventual return of the bond's face value at maturity. Unlike equity securities, which confer ownership and can yield dividends based on profitability, corporate bonds provide a fixed income and are prioritized over equities in the event of company liquidation. So again, just reiterating there, corporate bonds are a little bit more steady, a little bit more continual, and you're more set on how much money you're going to get every so often compared to equity securities that can be really volatile. All right, let's go to the next question. Okay, here is question 5. How do the forms of returns from equity securities compare to those from corporate bonds? Okay, again, we're 5 questions in. We've learned a lot through the other 4 questions. So pause the video, think through this based off what you learned, and see if you can get the correct answer. And when you're ready, come back. We'll look at the answer together. Okay, and the answer is that equity securities provide returns through dividends paid on shares of common and preferred stock, whereas corporate bonds offer fixed interest payments. And again, we've kind of already been through that in the other questions. This is just another iteration of it. Let's read the explanation. Equity securities, specifically shares of common and preferred stock, offer potential returns through dividends, which are paid from the company's profit and may vary in amount and frequency. Common stock may also provide voting rights and capital gains opportunities, while preferred stock typically offers fixed dividends and has priority over common stock in dividend payments and asset liquidation. Corporate bonds, in contrast, do not convey ownership in the company, but instead represent a loan made by the investor to the company with returns generated through regular fixed interest payments until the bond matures, at which point the principal is repaid. So again, corporate bonds, it's through interest payments, whereas equity securities, it's through stocks, like common stock, preferred stock, things like that. Okay, we learned a lot from just 5 questions. Before we go any further, let's do one more part of the process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice things that keep popping up. We've already had that happen in this video alone, where the same topics keep popping up in questions. These are the things that you've seen 4 or 5 times, and so you know they're important for the CPA exam, so you write them down as pillar topics so that you know them for later. So let's go ahead and look at the pillar topics for this video. Okay, here are the pillar topics. First off, equity securities. Equity securities, such as stocks, represent ownership in a company and may include rights such as voting and receiving dividends, which are shares of the company's profits. Corporate bonds are debt securities issued by companies to raise capital, offering investors fixed interest payments over the bond's life and repayment of principal at maturity. Equity securities primarily face market risk, where the value of the stock can fluctuate significantly due to company performance and market conditions, leading to potential high returns or losses. Whereas corporate bonds are primarily exposed to interest rate risk, where rising rates can decrease the value of existing bonds, and credit risk concerning the issuer's ability to make interest payments and repay principal. Finally, just talking a little bit about the transferability and liquidity of them, equity securities typically offer high liquidity and can be easily transferred among investors without extensive paperwork, making them flexible investment options compared to more illiquid assets like real estate. So just wanted to point out there that equity securities can be really liquid, which can be a really big advantage of them. All right, those are the pillar topics for this video. Thank you for watching. I hope you learned a lot. Make sure to go check out our free 1-hour webinar training on SuperfastCPA.com. Again, we teach the key ingredients to passing the CPA exam. It's not something you want to miss, and it's only 1 hour, and it's free. Make sure you go check it out. Also, we only went over 5 questions in this video, whereas Superfast CPA members will have access to the full 9-question video in this case when we post it on the members forum. So if you liked this, you can get more of it by becoming a Superfast CPA member. If you liked the video, make sure to like it and leave a comment. I hope this was helpful, and I'll see you in the next video.